Hello everyone, Julian Marchese here from marchesefinancial.com. In this video, I'm going to give you guys an update on my current positions and my thoughts on the markets today. So today is September the 20th, 2012, and the markets, well, at least the stock market, is sitting nicely at highs. We broke, obviously, 7 trading days ago on the FOMC announcement that QE3 was launched, which is an open-ended program, which the market obviously liked. It told me, this spike, that there were still a lot of shorts in the market and that QE3 obviously was not fully priced in. And I kind of still believe that it is not fully priced in. I mean, if we take a look back at previous QE, the first QE was obviously announced in November of 2008. And this was obviously the most successful QE as we were coming out of the Great Recession and the large stock market drop we saw in 2008 and the surrounding years. The second QE was announced in September and was implemented, I believe, sometime in November. I do not recall the exact date. But as you could see, basically using QE2 as an analog, expectations of QE2 and basically the announcement of QE2, but really expectations, brought the market all the way up to to new highs, new 2-year highs at the time. And when it was implemented, we further expanded and consistently rallied higher. I think that's kind of the case right here. Expectations of QE kind of fueled a rally into those highs, and then on the announcement of the ECB easing and then Federal Reserve easing, we finally had that break, that real breakthrough highs. And now we've been basing for the last 5 trading days or so, 6 trading days. And I think we're basically ripe to break out higher, and I've been positioning long for it. I think we could definitely take out this September 14th high that we made in the next couple of trading days into next week. One thing that has been on everyone's mind, obviously, is how extended we are. But in this market right now, take a look at hedge funds who have been underperforming the S&P drastically this year. Actually, only 11% of hedge funds have beaten the S&P 500 this year. And since the S&P 500 has been moving higher, we are going to assume that those 89% of hedge funds have been short. And the huge squeeze we've seen so far this month is basically confirming that hedge funds are still short. And since hedge funds typically have more of a medium-term horizon, so maybe a couple of months, and usually economic views, a lot of hedge funds nowadays are global macro funds, and since they hold economic views, it can take months to occur. So it is of my opinion that these shorts are still in the market, basically waiting for either the collapse of Europe or the failure of QE3 to instill confidence and bring the economy back up to full speed. So basically, I'm running off of the fact that I still think people are short and we should continue higher. So I'm short, I'm long equities right now. I was long oil, but obviously I got hit on this massive drop we've seen over the last week based on basically increasing supply. Demand and supply still works. Luckily, I was long through option contracts, so I did not feel the full pain of oil dropping. Basically $14 in a couple of trading days. Sorry, $12 in a couple of trading days. So I'm completely out of those now, and I'm looking to buy gold. I really like how we've popped up here, and I'm basically basing like the equity market. I'm pretty well leveraged in equities right now, so I don't really want to have any other positions at this point. But gold is something I'm taking a look at. I mean, this is a beautiful technical chart we have on gold right here. We had a very nice triangle pattern, but I don't really like to use triangles and specific patterns. Basically, we've seen a congestion in the price of gold since mid 2011 to just a couple of weeks ago, and we finally are starting to see some consistent movement out of it. And given gold's history on consistent movement higher, I mean, you take a look at previous years, how consistent gold would move up, 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 several weeks higher. I think gold has the potential maybe to close out the week basically maybe a little flat and to continue a push. We really have this small level in gold right here. Sorry, not even a small level, it's still a very major level at 1800. If we could get above that, we are basically going to new all-time highs in the price of gold, nominal highs at least. So we still got a lot of room to run higher. Basically, we are seeing central banks around the globe implement stimulus measures, and that's going to continue to see money flow into gold and the gold miners sector. I actually wrote an article in July of this year explaining why gold miners were a good buy, and it turns out that gold miners have been one of the best performing areas in the stock market over the past 2 months, and this is really showing the interest coming back in gold. If we take a look at gold miners, which will be the candles, and I'll put gold in the background, you can see even when gold was continuing to rise in 2011, basically these gold miners were not able to consistently rally with the price of gold and kind of went into this congestion pattern. And now it's basically re-entering this area, and gold is showing a lot of strength. So I think that we can see a continued move higher based upon the fact that gold miners and gold are moving in tandem. And to further emphasize that, take a look at GDX long gold short. So basically this is a spread on if gold miners are outperforming gold. Usually gold miners outperform gold when the economy is doing better and inflation expectations are high at the same time. And you can see right here we have a trend change, and we've been moving higher since that July low. And I think we still got a lot of room to go higher. So that's basically what I'm looking at the markets today, guys. I continue to be biased long in equities, and I should be for a while now since QE3 is implemented. Inflation expectations will remain higher. If you take a look at the tip spread, this is basically inflation protected securities versus just interest rate bearing securities, which are bonds. And you can see that we've seen a spike in the spread, indicating that inflation expectations are picking up, which is obviously good for stocks and commodities and bad for the dollar. And we've seen that through the rise in the euro. Take a look at the dollar falling. Although the dollar remains, and the euro for that matter, remains in a very long-term congestion zone. When this breaks, it's going to be a big one. And given Europe's current woes, and my opinion that they will continue to worsen, although not in the next couple of months, due to central bank confidence, or fake central bank confidence, I believe that this break will be higher. But for now, the trend is lower. It came into this channel to the downside, and so I will trade the technicals, which are telling me that the market is looking to go lower, at least leave US dollar, which would send equities higher. So I think equities definitely have a very real possibility of getting to all-time highs in the S&P and Dow in the very near future. I mean, take a look at the Dow. We are basically 500, 700 points off. It's basically nothing. We should be there. We could be there at the end of this year, which would be fantastic for at least bringing some confidence into the retail investor, which would be nice, especially right now, since the recent outflow of retail investors, which is understandable at the same time. So that's what I'm looking at, guys. Continuing to be long equities, long basically every asset class except for short treasuries and short the dollar. Thanks for watching this video, guys.